Good afternoon and welcome back to Lunch at the Market. Today's rally has given us the opportunity to get defensive. That might sound counterintuitive, but it's not, and we'll explain why. When we get nervous, and you know we did as we endlessly talked about raising cash for 2 weeks on Lunch at the Market. We also wrote an article for the blog 3 weeks ago on using the UUP and the VXX to protect a long portfolio to get ready for a market sell-off. Now that we have seen, hopefully, a good portion of that sell-off, you can see that the UUP is up just over 2% this year, while the S&P and Dow are down 5%. So that's how your hedge works. It takes away some of the pain because you have something that works opposite the rest of your portfolio through the VXX, which is the exchange-traded note that we use to track the volatility index, the VIX. The VXX is up 4% on the year and 12% from January 19th when we said the VIX had gotten way too cheap when it traded with it at 16 and change. Being up 12% in the month of January is much better than a sharp stick in the eye. You probably want to take a look at taking some of the VXX hedge off, meaning sell some of it as there's some noise in the instrument. I don't know that we'll see volatility back in the 30s. If you think we are, do not sell the VXX and you'll still have your hedge. We're going to leave the UUP on as eventually an improving U.S. economy should mean a stronger dollar eventually. So we should be able to stay long through the whole cycle. Okay, so what to do today? We're putting on collars. No, that's not referring to my attire, but an option strategy that is used to protect a long position. Take, for instance, VALE, the Brazilian metal and mining company. Jim Cramer sold most, if not all, of his position in this high beta name to avoid the massive volatility that comes from owning a high beta name like VALE. Beta is a term used to measure how much more or less a stock trades as compared to the index, say the S&P 500 or the Dow. A stock with a 1.59, which is the beta of VALE, it means it trades 59% of the volatility of the index. So you'll see 59% more ups and downs. If the broad market, the S&P, goes down 2%, you'd expect VALE to go down by 3.18%. The same is true on the upside. That's why people own high beta names. You just need to make sure that you know what you own. You can find beta of your stock by going to yahoo.com/finance, put your ticker into the Get Quotes box, and then click on the key statistics on the left-hand side under the company heading just below Profile. The beta is on the right-hand side under Trading Information.
Alright, so today, since we're talking about sophisticated strategy, we are going to use a visual aid. So if you'll just bear with us for a moment as we bring in our fancy-dancy aid and get it centered up on the screen so that way you guys can see. You'll notice that unlike CNBC's fancy show Options Action, we actually don't have a fancy computer-generated graphics. So here you go on a good old whiteboard talking about how to put on a collar.
Okay, so how do you put on a collar? You buy puts to protect your downside, and then you finance that by selling some upside calls. So what I like to do is pick a strike price that you're comfortable selling the stock at and sell that strike. So on VALE, we wouldn't mind getting called away at $28, so we sell the February 2010 28 calls on VALE for 53 cents. If the stock is above $28.53 on February expiration, the stock will probably be called away. To make sure that I can sit back and relax, I bought the February 2010 26 strike put on VALE. This means if the stock trades lower than $26, I can make someone take my shares for $26, even if they're trading for less. That's why it's called a put, because you can put the stock to someone for the agreed upon strike price. You also have the option of keeping your stock and selling your puts, which, if the stock is lower, will be worth more. That's a way to make money on your stock, even if it goes down, and keep your stock. I had to pay 66 cents to buy the February 26 put. That means it cost me 13 cents to put the trade on because I took the credit for selling the calls. If you want to put this on for a credit, look at buying the February 24 put instead of the 26 put, and you'll take in a credit of 35 cents. You know that you will probably have to sell the put for a profit in the decline, as you'll take a loss of nearly $3 a share on your stock. It just depends on what you'd like to do. Hope that helps you decide what to do in this market. Remember to sell an upside call of the stock at a price you're comfortable being called away, or you can run the risk of having to buy buy back your call at a higher price to stay long the stock. If you have questions, you can always go to the Magnum Opus Financial website and use the Contact Us section to send us a longer message, or just shoot us a stock on Twitter and mention us, and we'll cover it on the Lunch at the Market. Have a great trading day, and we'll see you guys tomorrow.